Hi, this is Lara at Elliott Wave Gold with your end of the week video analysis for gold for the trading week ending Friday 15th of February. The bottom line is gold remains range bound. We need to see a new high above 1325.74 before we can have confidence that the upward trend remains intact. If that happens, the target would now be at 1341. There's very strong support at 1300. I need to see price close below that level to indicate now that a high is in place. And then I want to see that blue channel on my Elliott Wave chart breached with downward movement before I have confidence that we have a high in place. At the weekly chart level, this is my main wave count. It expects that a huge cycle degree triangle may have very recently completed or complete in the next very few weeks for a huge B wave, the cycle wave B. Cycle wave A subdivides as a 5-wave structure. Cycle wave B could be a complete triangle, and then when I have confidence that we have a high in place, I will calculate a target for cycle wave C. But at this stage, this wave count is now at an absolutely critical juncture. I'm not prepared to calculate a target yet for cycle wave C until I have confidence that a high is in place. If primary wave E of this huge triangle continues any further, it may not move beyond the end of primary wave C, not even a fraction. A new high by any amount at any time frame above this price point firmly invalidates this triangle for cycle wave B. This wave count is my preferred wave count because it follows a very common Elliott wave pattern, and within this triangle it's unfolding in the most common way. The most common type of triangle is a regular contracting triangle, and that's what this one is. There's a single zigzag for primary wave A, a single zigzag for primary wave B, a double zigzag for primary wave C. One of the 5 subwaves of a triangle usually subdivides as a multiple, and the most common subwave to do so is wave C, so this follows a common pattern. Primary wave D subdivides as a single zigzag, and primary wave E could now be seen as a complete zigzag. I have an alternate wave count that allows for one more high. That is also entirely possible and has some support from classic technical analysis. We'll go to that next, or after the next chart. Let's now have a look at the first daily chart where primary D is this slowdown here. There's more than one way to label all of the subdivisions of this upward movement. I am going to present to you 2 different labelings for primary wave E zigzag, and I'm putting the Fibonacci ratios on the charts so that you can compare and contrast them. There really is very little difference, but this first wave count could be considered to have slightly better Fibonacci ratios. Primary E subdivides as a zigzag 5, 3, 5. I've got no problem with the brevity of primary A and the length of intermediate A and the length of intermediate C in relation to it. That's entirely acceptable. That's how it subdivides best. I can't see intermediate wave A ending at any of these other highs and meet all Elliott wave rules. Intermediate wave C is labelled in 2 different ways on my 2 wave counts. This first wave count sees the impulse labelled 1, 2, 3, 4, 5. It has a pretty good look. There's a normal small little overshoot for the end of the 5th wave, and there's some reasonable Fibonacci ratios. All of the subdivisions fit. If cycle wave B has ended here, then we need to see a 5-wave structure develop downward for a trend change at cycle degree, and that would be incomplete at the daily chart level. The first wave down may be complete, and a relatively deep second wave correction may be complete. If it continues any further, it may not move beyond the start of 1 above this price point. If this wave count is invalidated, then I will use the next wave count. We'll just quickly look at the hourly chart first. If cycle wave B is over here, then I have to see this wave down here as a 5-wave structure. Now that's entirely possible, and this actually still follows a pretty common pattern for gold. Members who have been members for a while now will know this explanation. Gold, typical of commodities, exhibits swift, strong fifth waves, and those swift, strong fifth waves are really common to end its third wave impulses. And when they happen like that, they seem to force the fourth wave that comes immediately after to be much more brief and shallow than usual. And it gives gold's impulses quite commonly a three-wave look to them. So there is quite often for this market a disproportion between its second wave and its fourth wave corrections within a five-wave impulse, and so this is reasonably acceptable, although in this instance it really is quite extreme. If this is a five-wave structure complete down here, then the only way at this stage I can see this upward movement subdividing as a complete corrective structure is as a double combination. It fits quite well as a double combination, but the only problem here is minute wave Y, which is a flat correction, has managed to move reasonably above the end of minute wave W, not achieving just the purpose of taking up time and moving price sideways, but also deepening the correction. Combinations are usually sideways consolidations. They're not usually sharp reactions in a counter-trend movement, as this one is, so this is atypical. If minute wave 2 continues any further, it may not move beyond the start of minute wave 1. The target is calculated for minute wave 3 to exhibit the most common Fibonacci ratio to minute wave 1. And this is the second way I'm going to label intermediate wave C today. It could subdivide 1, 2, 3 could have been over at the last high, 4 could have been over as a pullback within a counter-trend movement within the ongoing upward trend, and 5 could be yet to unfold over the next 1 to 2 weeks up toward the target. The target expects primary wave E to fall reasonably short of the AC trend line. This is copied over from the weekly chart, and that's the most common look by quite a wide margin for E waves of triangles. At minor wave 5, if it gets up there, may find resistance at the upper edge of this Elliott channel, which I've drawn from 1 to 3 with a copy on 2. The Fibonacci ratios are, there's a very good one here, a barely adequate one here, and none here. So the Fibonacci ratios for this alternate idea aren't quite as good as for the first presented daily chart. The channel is slightly different, but not too much. If we get a breach of the channel, that would provide a lot of confidence that we finally have a high in place, and we do not have that channel breached yet. At the weekly chart, this is the other remaining idea for cycle wave B, which sees it as incomplete. It could be continuing further as a double zigzag. The first zigzag in the double may be a complete zigzag, labelled primary wave W. The double may be joined by an incomplete corrective structure in the opposite direction, labelled X, and then this wave count would expect a second zigzag for primary wave Y to deepen the correction, because that's the purpose of multiple zigzags, and they should have a strong counter-trend slope. To achieve that slope and its purpose, primary wave Y would be expected to move substantially above this high, labelled primary wave W. Turning our attention now to the structure of primary wave X, this is subdividing as a regular contracting triangle. That's a pretty common structure, but not so common for X waves. X waves are almost always zigzags, and so this is not following a common pattern. Within primary X triangle, there may be a zigzag for intermediate A, a double zigzag for intermediate B. One of the 5 subwaves of a triangle should subdivide as a multiple. It's most commonly wave C, but it doesn't have to be. Sometimes wave B will do this. Now this is acceptable, but it does not follow a most common pattern. Like the first wave count does follow a most common pattern, and that's why I'm presenting the second. In terms of Elliott wave, I have to judge it as having a lower probability. There's a single zigzag possibly complete down for C. A single zigzag for D for this wave count would be incomplete because it would need to end here at the BD trend line, which I'm drawing across these two highs. because Elliott wave triangles almost always adhere very neatly to their trend lines. If I pull this trend line down any lower, then this would be an overshoot, and that would not have a normal, typical look for an Elliott wave triangle. Here's a nice little example. This triangle adheres very neatly indeed to its trend lines. And so this wave count needs some more upward movement for the BD trend line to look right. When that's done, a short little zigzag down would fall short of the AC trend line for wave E to complete the triangle for wave X, and then a massive trend change and a big bullish move to last several months for primary wave Y would be expected to move reasonably above this point for this wave count. And finally, this is a very bullish alternate which I presented first last week, and I'm only doing it because there is currently an upward trend in place. And so I'm trying to consider, what if my preferred wave count is wrong? And it's always important to consider alternates when you're working with Elliott wave triangles. They're very tricky structures. What if that wave count's wrong, despite it looking very good and following a common pattern? What if it's just wrong? What if something else is happening? What else could be happening? If there's a massive trend change here and gold has been in a basing action for the last 3 years, how would a bullish Elliott wave count fit? If this is a major low, then from this low to this high, the Elliott wave count has to see this as a 5-wave structure, because a new trend, a new bull market, needs to begin with a 5-wave structure. Now, I can force this as a 5-wave structure, but there's a very big problem in the gross disproportion between primary waves 2 and primary waves 4. Gold will often exhibit disproportionate second and fourth waves within its 5-wave impulses, but when it does that, it's the other way round. It's the fourth wave, which is brief and shallow, and the second wave, which is more time-consuming and deep. That's because gold, typical of commodities, often exhibits swift, strong fifth waves. That tendency is especially prevalent for its fifth waves to end its third wave impulses, and it tends to force the fourth wave that comes immediately after to be more brief and shallow than it would otherwise be, giving gold's 5-wave impulses quite a 3-wave look to them like this. Here's a good example, and here's another very good example. This fourth wave is brief and shallow, the second wave is deep and time-consuming. But here it's the other way round. The fourth wave is time-consuming and large in terms of price. The second wave is deep, but it's very brief, and compared to the fourth wave, very small in terms of price. They look grossly disproportionate, and the disproportion is very unusual in this direction for the fourth and second waves. That must reduce the probability of this wave count by a fairly reasonable degree. If we have a 5-wave structure over here, then we could have a corrective structure in the opposite direction complete down here, subdividing as a double combination. The first structure could be a zigzag labelled primary wave W. The double could be joined by a 3 in the opposite direction labelled X, which is subdividing as a zigzag. That's the most common structure for X waves. And then primary wave Y could be a complete flat correction, subdividing 3, 3, 5. This piece of the analysis has a very good fit, and it follows a pretty normal common pattern for a corrective structure. Not the most common structure for a second wave, but double combinations are not rare structures. If the second wave is over here, then a third wave should be underway. This upward movement, which has now lasted 26 weeks, should be beginning to gather strength. It should be beginning to exhibit an increase in momentum, and it should have support from volume, because this should be the start of a third wave. Third waves should be unmistakable, but that's not what's happening. We've got momentum is increasing, but it still hasn't gotten beyond the point of the more extreme part of momentum within the second wave prior to it, so it hasn't really increased enough yet. It does not have support from volume. It also doesn't have support from increasing ATR. ATR continues to quite strongly decline. This does not look like the start of a third wave. This wave count does not have a good Elliott wave fit, nor does it have support from classic technical analysis. It has quite a low probability. I'm publishing it though because I always want to consider, what if I've got it wrong? What else could be happening? It's important to consider alternates and then rank them according to probability. For this wave count, within primary wave 1 impulse, intermediate wave 4 may not move into intermediate wave 1 price territory below this point. Let's look at the week's classic technical analysis now. For the last 2 weekly candlesticks, there are long lower wicks. These are bullish. This weekly candlestick could possibly have been considered a hanging man, but the bullish implication of a long lower wick requires bearish confirmation for a hanging man to be read as a bearish candlestick reversal pattern. We do not have this week. We have another long lower wick. So far, this is looking like tests of support, a small shallow pullback within an ongoing upward trend. Look out for strong resistance above at 1365 to 1375. This look here supports my alternate daily Elliott wave count. This week is an outside week with a higher high and a higher low. The balance of volume is upward. Upward movement within the week has more support than the previous downward week, but overall volume is showing some decline as price essentially is moving sideways, so I'm not going to read that as particularly bullish. On balance, volume remains constrained. There is no signal there. ADX at this time frame is indicating still an upward trend. It's indicating it's extreme though, because the ADX line is now above both directional lines, and so look out for signs of a trend reversal. We do not have that yet at this time frame. ATR continues for years now to show a very strong decline. That offers a lot of support to the Elliott wave count, or 2 of them actually, that see a B wave unfolding, and it very definitely does not offer support to the idea that we have a major low in place and that gold is within a new bull market, particularly a third wave beginning with declining ATR. That just looks wrong. It's possible, of course, it just doesn't have support from classic technical analysis. It would be a very unusual way for a third wave to begin. RSI at the weekly chart time frame is still just in neutral territory. There is a bit of room for price to continue higher. When markets are trending, stochastics can remain overbought for reasonably long periods of time, and so just because this is overbought does not mean upward movement has to end yet. At the daily chart level, this looks like another flag pattern. This looks like an upward breakout. Prices closed above the upper edge of the flag, but very importantly, it has not done so with support from volume. Upward breakouts absolutely require support from volume for confidence. I do not have confidence in this upward breakout, and that's the main reason why I'm still presenting that main Elliott wave daily chart as my main wave count. On balance, volume remains bullish. RSI still in neutral territory, plenty of room for price to continue higher. ADX is now declining after telling us there was a previous upward trend which reached extreme as prices moved slowly lower in choppy overlapping movement. ADX has been telling us the upward trend may have ended, which for now it may have done so. ATR is overall fluctuating, but overall declining as price is moving sideways. Stochastics back in neutral territory, MACD bearish. That's all from me with your gold analysis this week. I hope all of our members are having a most fabulous weekend.